what we have here is a 1217 contract monthly options expiration put that's in the money 575 put. What are we going to compare it to is the inflated price, and we ran up here to the highs in that put side. I'll come back to it here in a moment. But you can figure that since Google has been selling off with the broader markets, that it has done what? It has sold down in here. It got to the lows, now it's at the highs. But here's the wonderful side of it. The 580 December call is what we're looking at. One of the things that I'm going to point out with the MMTs is that it wasn't very long ago on 11/15 that the high was $45. Yes. And when the market sold down, they took all the call premium down. Oh, yes. The very low end of that closing, 11/25. Happy Thanksgiving week. And welcome to our friends around the world. The low got to 940. The low got to 940. They have taken out that premium to a wholesale deflated bid. And they can get a little bit more wholesale depending on what the broader market wants to do. However, for up and out of the money, 580 call is deflated, can get a little bit more. We would be looking at trading this deflated premium here. I am telling you that the call side right here, the high of it was 45.05, the low 940. That is deflated in price. They can still come down here. There were other lows that got down to 630, and there's some other lows around 760 that they can still come down to in this lower price pocket. However, if Google chart holds the trend as we anticipate, that's that Google daily chart. Once again, here it is upon us. You can see earnings gap. You can see the reversal. You can see how it's filling in the gap. If we hold the lower daily delta, half delta line, and we start to build, we could have an upside rally. Or if we break below this diamond area in here, we could have another rally in the put side of the market. That's the daily chart. On the put side of the market, they were wholesale over here. Look, 11. This put is over $10 in the money. So let's get that straight. It's in the money put. Google closed at 563. In the money a put alert. In the money a put alert. In the money put alert. And the lows were when Google was up there, it was down at 510, and the current high in this put right now is hitting 22.90. What a great side. They really have marked that up. They're not deflated. They were mathematically deflated at 510 and buyable when the market sold down 1 day, 2 day, 3 day, 4 day, 5 day, 6 days. They went straight up right along with all the bear funds as well. Directional price movement, they went straight down to that deflated low. Look, now they're right back up at the ceiling. If we were to continue selling in Google, is there an upside here? Yes, there is. I can show you. The contracts can go higher. Hell, right over here, the low was $36. Over here, the low was $27.20. Remember that if Google was to break down and the Google daily chart broke down in those gaps, they break the gaps and you go down, guess what happens? Then the put side will go up. So that's the scenario. Now, having said that, these are getting to a deflated area. These are not totally inflated. They could go a lot higher, and these could still drop down to $5.50 even. So the thing about it is, it's a calendar monthly trade on the 580 call versus the 575 put. There's another one on the 565 put. We can see here where the 565 put was, and that we already did this one in a separate video. So as far as the 560 put goes, which we already featured, you can see where that 560 call is coming down to, and we're going to be watching that one, and I'll put in the 560 puts that are well below the market for that calendar period of time. And the put side of the market on the 560, as you can see, they were $4.10, and the high here now is 1535. So the put side has been marked up during the broader financial reversal crisis worldwide with markets. Google and the calls are coming down. So another call we're going to look at is a 590 call. And we can see that the 590 calls were up here just at this high was 36.20, and the lows down here, I'm sorry to tell you, they're $6. I'm taking out all the capital risk premium on my entry, and they can go a little bit lower, but it depends on what the daily chart does on Google and how it meets our criteria. Once again, there is a 560 put. If I was to look below the market, say that I wanted to look at a 540 put below the market. We can see here on the 540 put below the December market that low was $2, and the current high that it shot up to was $8.80. Made a $6 movement in premium below the market. Remember, this was well out of the money put at the time that it made the movement here, and they can go higher. I mean, at one time, the very same put was $69 back on 10-4 when the broader rally started. But just even so, let's take a look at some of these highs over here. On the 18th, they were as high as $14.50. They still got room to go. But we'll be looking at various different ones. Let's take a look at the 555 put. 555 put. Take a look at that one. Take a look at the low, $3. Take a look at the high, $13.32. That put side, and it can go higher. I mean, the gap down over here on this calendar date on 10/13, that high was $36, depending on what the market wants to do. But we want to be ready for that 555 put, and that's a December 17th 555 put. 555 put. Let's take a look at the 530 put below the market. The low was $1.65 and the high is $6.50. They made a nice movement. But look, these puts at one time were worth a lot of money up here. They were $63 on the high. It's in the video here. Let us not joke it. Yeah, they got deflated, okay, where you could be buying them, and we will. But we're going to be looking below the market in case these markets get out of control. These highs over here were $12.40. Yes, they can still move higher. The close was $6.20. These current little highs over here in this area are $12.40. Yes, yes, yes. There are $10 highs that were set in on the 26th over here as far as the puts going higher. Yes, yes, yes. Not only that, that meant that the call could come down to 3.5 over here to $2.5. Yeah, yes, it can. That's that 590 call that we're looking at. So we're looking at where the values were, where the inflated and deflated of both sides of the market is. You can't find it in books. You can't find it in CDs. You can't find it in day trading option coaches, because once again, it's how do I make markets and balance the call and put side of the market. Here's another one that we would be looking at is this 1217. It's a call. It's going to be on this call chart, and here's what it's going to be. It's going to be up and out of the money, $600 call. They're getting cheap. They're getting cheap, $370 markdown, $370 markdown from $30. They're getting cheap, could still get marked down to $1.50 to $2.20. Come on down lower. That's a $600 call up and out of the money for a December rally. Let's take a look up and out of the money, 605 call. That's where the stock broke down. Look at it, $2.80. $2.80 on the low on this 605 call. Take a look up here, MMTs, a high of 26.30. That means that this side of the market's getting deflated, and it's all going to be dependent between where the buyers and the sellers and the worldwide markets are. It's about how this daily chart is filling in the daily gaps on Google. It's about how do I get calls and puts, how do I look up out of the money, what happens, how net can I take out the capital dollar risk to entry. Hello, let me scratch my head. What does he mean? He's saying I don't have to buy them at $25.80 a contract and ride them down $23. No, we're looking at where the most deflated side of the market is relative to where Google will bounce off support levels and take the deflated premium back up to a higher premium and let you exit with your Santa Claus trade. Once again, I've concluded some up and out of the money calls in the money puts. One of the things you're going to want to do in the short term is monitor this put option here. This put option is a 1125 put, and it took off from, I'm going to tell you where it took off from. You can see the high is 37.94 over here, and it's 1125 $600 put in the money, because this is what this is. So I want you to clearly see that this $600 put for a weekly expiration, because if this thing comes down in value from its inflated price up here on the weekly put, the 600 put loses all its value again, then that means that your call side of the market now, here it is. Here it is. The $600 call. Down here right now at 2 cents. Here's where it was. That was an 1125 expiration, and I'm showing some of the 1125s of how they closed here, because that's how they closed. So the call side really got taken down in the last week's expiration, because it did. And the thing about it is, you're going to be watching how some of these put options on the weeklies have done their thing. That's a 12.2. And what strike 540 put in the money. But look at the premium they gave it. Gave it $1.20 on a weekly. And it's way out of the money. I mean, but nonetheless, markets are markets. So I'm going to conclude the call and put strategies and how markets can be made from where they've been marked down to where entries would be made and exits on sells for dollar profit gain.